Time for us to take a look at what has been an interesting past few days since the sitting of the first few sittings of the newly constituted Monetary Policy Committee of the Central Bank of Nigeria, chaired by the Central Bank Governor Olayemi Cardoso. They've announced and rolled out interventions as well as new guidelines yesterday in Abuja on Tuesday. Let's bring you this report put together by Trust TV's Chamunda Beng on the outcome and the resolution of the Monetary Policy Committee and what this means for Nigeria's economy going forward.
Raise the MPR by 400 basis points to 22.75 from 18.75%. The committee's decisions was centered on the current inflationary and exchange rate pressures, projected inflation, and rising inflation expectations.
Well, as you can imagine, this particular development has elicited mixed reactions from experts, economists, financial analysts, and Nigerians who understand very little about the economy regarding what comes next, whether this is the panacea or perhaps even going to further complicate an already delicate situation. Well, let's talk to someone who understands these difficult waters. Join us on the program this morning is Professor Mike Obadan. Professor Obadan is an economist, an educationist who has authored many books, and he is also a former Director General of the Nigeria Center for Economic Management and Administration. Professor Obadan is also a past member of the CBN board and a former member of the Monetary Policy Committee. Prof, good morning. Thank you most kindly for joining us on Daybreak this morning.
Good morning. It's my pleasure to be with you.
Right. First and foremost, I just want to get your reaction to this particular development vis-a-vis the current state of the Nigerian economy. What are your thoughts?
On the Monetary Policy Committee resolution?
Yes, exactly.
Well, the Nigerian economy, as at today, is in a stagflationary situation. That is to say, is experiencing low or fragile growth, economic growth, and at the same time, very high inflation rate. Which has caused a lot of concerns, to Nigerians because of the negative impact on purchasing power, on businesses, and various enterprises. Well, let me say that the Monetary Policy Committee was genuinely concerned about the rising trend, escalating inflation, in the country, the rising inflation expectations, the escalating exchange rate, and among others. And so we can say that, yes, the move or the decisions by the central bank yesterday were in the right direction, but the magnitude of change of the policy instruments is rather very worrisome. For instance, the monetary policy rate, for the first time in Nigeria's economic management history, was increased by 4% from 18.75% to 22.75%. And secondly, the cash reserve requirements expected to be complied with or met by the deposit money banks was also highly jacked up from 32.5% to 45%. These constitute, for me, a relative overdose of the policy instruments. I agree that there is the need to tackle inflation, but these changes tended to assume that the inflation in the country is purely a monetary phenomenon.
Right.
But which is not. And the governor in the communique did acknowledge that there are several non-monetary factors, that drive inflation in Nigeria as of today. One of which is the infrastructure deficits across the country, exchange rate escalation, which has pass-through effect on domestic prices of goods and services, and fiscal deficits of the federal government, which has tended to increase over time. And then, of course, the impact of insecurity all over the country, impact of insecurity, on the production of food, and other goods and services. Also impact on investment, domestic investment and all that. If that is the case, if the bank acknowledges the important role of these factors, then an attempt to rely on monetary policy instruments alone to address the inflation problem would not be the right thing to do. Because what is happening in this case is that monetary policy is being, overburdened to address the inflation problem, whereas there are numerous other factors which need to be addressed, to be able to contain the inflationary situation.
Right. I appreciate that, contextualization of what the problems are and what the CBN is trying to do.
Yes.
Some have said this is just the CBN trying to control what it is in control of, as you did say, and as that communique pointed out, that this is just one variable of so many other variables within the economic setup itself. So if you weigh, the decision in that communique from jacking of the MPR from 18 to 22%, as you said, this is quite irregular. Usually what you have is between 1 point something or maximum you get 2% increment in the MPR. Give me your take on what the impact is likely going to be right now, knowing what we know about the volatility within the economy itself.
You mean the impact?
Yes, the impact of the MPR.
The impact, not just the MPR, the combined impact of the monetary policy rate, hike, and the sharp increase in the cash reserve requirement. The expected impact is that if these two policy instruments work as expected, the liquidity in the economy or the money supply will be reduced. And so the monetary policy instruments are expected to signal to the deposit money banks to do everything to reduce credit creation, lending, as it were, but by they themselves also hiking lending rates. And so if lending rates increase, that is not a positive development for the real sector of the economy. It's not a positive development even for government financing. And it's not a positive development even for the commercial banks themselves. Because when interest rates keep rising, lending rates keep rising, it increases the possibility of increasing non-performing loans. And so what is likely to happen is that if the policy instruments work as expected by reducing the ability of commercial banks to create credit and invariably reduce liquidity, the impact may be devastating on economic growth. That's likely to discourage investors, and they will be borrowing, those who borrow from the banks will be doing so at high cost. And in that case,
so debt servicing is going to go up significantly for especially businesses, right?
Pardon?
Debt servicing, yes.
That is the expectation. That is the channel. When all these instruments are implemented the way they are now to be implemented, increase cash reserve requirement, that is to say, every deposit that the bank receives is now going to keep 45% in the central bank idle. It means the rest is what they can struggle to lend. And yet we are saying that we need the private sector production to expand so that the growth prospects will be much better. So invariably, if it happens, it's likely to negatively impact on economic growth. What will also add to that is the fact that at the present time, consumer demand for goods and services has weakened tremendously. And if that is the case, it means you have a combined effect of two policies on growth, increased cost of borrowing money, which will discourage some investors, and then consumer demand is weakening in the sense that because of the high rate of inflation, not many people are able to buy goods and services as before. The combined effect of that, I fear very strongly, is the possibility of driving the economy into a recession or very low growth situation.
Right.
So in that case, we may be achieving one goal, reduce inflation at the expense of the other. The governor, I must concede, did acknowledge this possibility that with the policy instruments, there might be a trade-off between price stability objective.
Right.
If achieved, it could lead to negative impact on economic growth. But is that desired in the circumstance in which inflation is not purely a monetary phenomenon? There are many other factors even which the governor even acknowledged. One of them is exchange rate escalation. The bank can do something about that one. But at the moment, when the bank is insisting on, market determination of the exchange rate, then the problem will be compounded. The exchange rate will be escalating, because of limited supply in relation to demand. And if that is the case, when these policy measures are being implemented, it means that one will tend to negate even the expected positive impact of the tightened monetary policy environment.
Right, right. And in talking about the expected impact of this, clearly the MPC sees all the positives while acknowledging, the negatives, with the negatives and the variables that it is not in charge of. We talk about inflation control as one of the measures, because this is supposed to address.
The goal.
Yeah, that is the goal, exactly. And of course, there's also the issue of currency stability, because the naira right now is doing really badly, and we've seen, a rebound of some sort over the past few days. He did talk about the BDCs and extensively. We get to expand that also. But do you think, this is largely going to be counterproductive after everything is said and done, largely because of the fact that the monetary aspect is just one aspect of a myriad of challenges that is inundating the economy at this moment?
It's likely, in light of what I have just said, because what is happening now is that financial conditions are tightening, and that means that lending rates, are very likely to rise if the commercial banks respond. And if that is the case, and I believe they will respond, they are only reluctant to respond to reduction in interest rates. But when you increase the monetary policy rate, the asymmetric relationship plays out. You find the commercial banks quickly adjusting the rates. So invariably, what one would expect is that the factors which the central bank can control, it should also work on them. For me, central bank can control the escalation, of exchange rate. But to the extent that the bank insists that it's market determination and willing buyer, willing seller approach, which is market, a buyer and seller foreign exchange negotiate and agree. If that continues, then definitely it's going to negate whatever gains that are likely to be obtained by tightening the monetary policy instruments. So the impacts, are likely to play out.
The CBN governor, while explaining some of these points, said, this is all evidence-based. This aggressive move is evidence-based. They've seen reason why they should go in this particular direction. You've said that there is a sense that this might be an overdose. Some say it might be an overkill, and it could be counterproductive. But let's go down history, memory lane, and remember, we've been here before several times over the past 3, 4, 5 decades in this country. When you were, a member of the MPC, give me a sense of what goes into these recommendations and that end up becoming a part of the communique. We've had to, overcome hurdles like this before. We've had to survive recession recently 2 or 3 times between 2016 and 2021 when the pandemic hit. Give me a sense of, some of these textbook approach to addressing these, economic volatile situations.
Well, the committee invariably took cognizance of the economic realities, the data on economic trends, financial conditions, gross domestic product. During recession, Nigeria had 2 recessions in the last 9 years or so. In such a period of recession, there is the desire for the bank to support economic growth. And so, hawkishness in monetary policy instruments would tend to be ruled out. In fact, in other economies, in such situations, the monetary policy instruments is reduced.
Right.
Like happened during COVID-19 in the advanced economies. Interest rates continued
to go down.
Right. But in Nigeria's case, I think we were just able to reduce the monetary policy rate once. But that's because the inflation rate was not comfortable. And so there was the need to focus on, controlling inflation and at the same time also support economic growth. And I will say this, that the stance as at the moment, it seems to be that economic growth is not important to the central bank. But that may not be correct.
You think it's missing the bigger picture here?
Yeah, that's what it seems. Because let me tell you this, that there is virtually no economy that does not support, where the central bank does not support economic growth. Even the United States Monetary Policy Committee, one of the 2 primary objectives is to ensure price stability, and the other one is to generate employment. And you don't generate employment unless the economy is growing and is creating jobs. So even the United States has a focus on growth perhaps indirectly.
There needs to be a balance.
Yes, as it were.
Right.
There needs to be a balance. But I understand the concern of the current team in the central bank. Let's focus on, our primary mandate. But I will say that to the extent that the fiscal authorities are not really complementing the efforts of the central bank as desired. So central bank cannot completely take its eyes away from supporting growth. It can still do selective development finance interventions. Providing access to productive private sector enterprises to access cheap credit.
Cheap credit, right.
That is how it can support, economic growth.
Yeah, and this is obviously going to tighten and slow down some of these points that you've just made right now. If you're trying to create jobs, if you're trying to stimulate the economy, some of these indices are supposed to be in favor of all of these things. However, this suggests that, while we're trying to control inflation, we're trying to stabilize the naira, we're risking a variety of other issues that are equally important towards economic prosperity and development. But give me your take on the short and long-term effect here, because apparently this is the direction of the Apex Bank, and we have to just deal with the consequences of it. But give me your projection as to what may be the short and long-term effect of this, and is there a chance that we can weather this storm of economic slowdown, financial tightening, and things like that, and whether there's a possibility of it being a net positive move in the near future?
Well, let me say this straight away, that the issue of whether there's possibility of getting a balance, I would say yes. In the situation of stagflation that the country currently experiences, if the federal government, had a fiscal muscle, that is to say, is able to generate enough revenue, naira revenue, to finance its various, development programs, budget and development programs, then in such a situation, we can rely on the government to support growth, provide all the incentives, fiscal incentives, and to support economic growth, while the central bank may wish to concentrate primarily on this primary, mandate of growth. So in such a situation, we can have a balance. While central bank is fighting inflation on the one hand with all the instruments it has, the government is also using fiscal policies to promote growth. So the damage of the monetary policy tightening may be less, on growth. But we all know that at the present time, government is a fiscal capacity is rather limited.
Right.
Even with the removal of subsidy and the floating of the naira,
Right.
through which the government seems to benefit significantly. The more the rate depreciates, the more naira revenue it gets from exports of oil in particular. Then subsidy, you don't pay subsidy again. But is that really so as of today? Because the various indications, even from the International Monetary Fund, is that the federal government is paying subsidy because of the escalation of the exchange rate and the fact that all the petroleum products consumed in Nigeria are imported. Because of the escalating exchange rates and the fact that global inflation has really not moderated to the extent to which those countries desire, that the landing cost of fuel probably is far higher than what consumers are paying. And if that is the case, it means then that part of the gains from subsidy, may now be used invariably for also to subsidize indirectly.
Right.
So invariably, a balance could be struck if government has adequate fiscal muscle or fiscal capacity. You said the short and long-term effects. Well, I've already referred to them, directly and indirectly. In the short term, we expect the lending rates of commercial banks to increase. If that one happens, then it will limit the ability of private sector enterprises, to borrow for production. And they will also be a bit skeptical, because if the interest rates are rising and they are borrowing at very high cost, it means they'll be producing at very high cost. If they are producing at very high cost, goods and services prices may rise.
Right.
That one may negate the positive effect of the policies. So in the short term, that is expected. And also, because the rates have jacked up, government's cost of borrowing may increase. Already the government has been, borrowing through treasury bills at very high rates, sometimes, near 20% or thereabout. That may also be the case in this case. Well, let me say this also, that, like I said, the non-performing loans of the commercial banks may increase because much higher lending rates reduces the ability of borrowers to repay the loans.
Right. So there's going to be a lot of defaults.
Yes, a lot of defaults, and that one can affect the financial stability indicators, of the commercial banks. And not least, even in the short term, is the impact on the stock market.
Right.
For some time, until maybe a few weeks ago, the stock market appeared to be in a boom. Prices were rising. It's possible that there were manipulations and so on. But you see, interest rates have a negative relationship or inverse relationship with stock market prices. And so if general interest rates continue to trend upwards, it's likely to reduce prices in the stock market, and that one invariably might result in losses to investors and all that. So in the long term, the net impact is likely to be on growth, economic growth. And in the long term, the central bank may achieve its objectives. But with the analysis I've done, that prices of goods and services may even rise.
Right.
Then you find that the possibility of reducing inflation significantly is relatively, moderated, as it were.
To put it simply to our viewers, we may miss the target. To put it simply, we may miss the target. The CBN may actually miss the target.
There is a possibility.
Right.
I'm not sure the central bank's optimism is such that it expects, to achieve a reduction in the inflation rate from 29.9% to 21%. That is its target for this year. But with the coalition of various factors at play, the balance of probability may be that the net effect, on inflation of the various policies might not be strong.
Yeah. And in talking about the pains versus the gains from this new direction, obviously we're talking about businesses likely shutting down because they can't stay afloat, people losing their jobs,
particularly micro and small businesses.
Right, exactly. Give me your take on whether you think there's an alignment with what the CBN is currently doing and what the Tinubu administration is trying to achieve with all its economic reforms. Do you think that there's an alignment here?
And not quite. The Tinubu administration actually desires very low interest rates. You know, they've said it publicly, president and so on, and justifiably so, to be able to promote high rates of inclusive growth that can reduce, you know, unemployment, you know, and reduce poverty. The jacking up such rates will not achieve that one. It's not likely to achieve that one. So, yes, the Tinubu administration, government, would like a stable, you know, financial system, would like inflation to be reduced. But I'm not sure that the administration will want a situation that inflation is reduced and growth, you know, is adversely impacted to the extent that we'll be fearing possible trend towards a recession, you know, of the economy.
Let's talk about the whole naira-dollar exchange saga that has caught the imagination of the country over the past few weeks. We've seen the naira plummet and continue to plummet, went down as low as 1,900 naira plus to the dollar, even though we've seen a rebound over the past few days. We also understand that the CBN has announced a decision to distribute $20,000 to each of the eligible bureau de change operators across the country. It is also trying to streamline some of their operations through licensing and, you know, setting some parameters to address some of the irregularities in the industry. What is your take on the CBN's approach to address this volatility that may or may not be a factor of some sort of liberalization of our foreign exchange market?
Let me say this, that liberalization of the foreign exchange market determination of the exchange rate is good where certain conditions are fulfilled. One of which will be a very strong balance of payments position, strong external reserves position, in which and the citizens' appetite for importation of goods and services is moderated. And when you do that, and the export base is very robust, such that export earnings, you know, come in and boost foreign exchange reserves, which can be used, you know, to support, you know, the market. But if those conditions are not there, and you say the market should determine the exchange rate, what will happen is what we are getting now, a situation whereby the exchange rate continues to escalate because there are economic agents, be they speculators, institutions, or even banks that manipulate the market with impunity. And they manipulate the market and keep jacking up the exchange rate by their actions. So under such circumstances, normally, you know, it's clear that the market is imperfect. Even the governor in his, you know, communique briefing alluded to that, various distortions, you know, and distractions.
He talked about $26 billion, you know, from unknown sources passing through Binance, which is a crypto exchange platform, in just 1 year. And we talk about illicit financial flows and how to curb it. Do you think this new normal, which is the cryptocurrency space, do you get a sense that the CBN is, you know, attuning and adapting very well to, you know, the shock that cryptocurrency, you know, is sending through the financial system?
I think they are trying to adopt. The the challenges posed by cryptocurrencies through their various institutions have been well known. And that was the reason why the previous management of the central bank was not receptive of cryptocurrencies. The destabilization of the financial system and then the foreign exchange market that could occur. And so I think this new team is also appreciating that one. And that's why it brought out the issue of Binance and then the amount of money that went through. But if the management team, believes that it can put in place regulations, control measures that are effective, then it can go ahead and tolerate them. Otherwise, it should not be tolerated.
What does your gut feeling tell you?
That
on what to do about this this new frontier?
Yeah. No, I think the bank should be allowed to implement whatever measures that it has come up with in relation to checking the possible nefarious activities of these cryptocurrencies groups and so on. And if it will be an experiment, they've just come on board, and if over time they find that the activities of these companies are not in the interest of the economy, I believe they will do the needful and might have to find a way to stop them. The BDCs that you mentioned are being returned. Happily, the governor mentioned in his address yesterday that there were, in the past, serious abuses connected to the Bureau de Change operators. It was actually because of those abuses that the previous management of the central bank, excluded the BDCs from accessing official foreign exchange. They were not banned because they had licenses, but they were not, allowed to access official foreign exchange because their activities were found to be injurious to the economic health of the country. The activities tended to sabotage the monetary policy of the central bank, in the sense that they were expected to, buy foreign currency from the central bank at a particular price, as they were considered as part of the official foreign exchange market. And then they were to sell at a margin. But for quite some time, it became clear that they were not doing that. And rather than buy and sell at the expected margin and then help the central bank to stabilize the naira, then they were buying from the central bank and selling in the parallel market. In other words, by their activities, they had become part of the parallel market and not part of the official market, aimed or designed to stabilize the naira and the financial system. So invariably, if the new administration believes that it's in a position to effectively checkmate the activities of BDCs and that they will not do the round tripping for which they were barred from accessing the foreign exchange, then they could go ahead with them. Otherwise, it may not be advisable. We might be returning to the situation that existed, before. It means central bank must have the capacity to effectively monitor their activities. Perhaps the new guidelines, which have been released by the central bank, may be helpful in checking their activities. But central bank management will be on the alert with respect to the activities of BDCs.
Yeah, and that is what indeed many Nigerians expect from this one. Now, going back to the MPC meeting itself, it roughly happens 8 times in a year, or once
Six
every
times.
6 times.
Yes.
Okay, 6 times. So likely once every 6-8 months. 8 weeks.
2 months.
2 months. So
Yes.
so it's 8 weeks, give or take. Give me a sense of what may likely happen from the analysis and from the reaction we've been getting from experts like yourself. What do you think will happen next time they meet? Given all the projections about the stagnation within the economy and what the likely impact is going to be. Do you think we're going to see a reversal of this increment? What is likely going to happen in your view?
Yeah. Well, let me say that in light of the forces currently at play, 2 months, no, actually 1 month, because they've indicated that they will meet in March, which means 4 weeks. That definitely will not, that period is not enough for
to gauge.
Yes, to gauge or assess the positive or negative effect of the current policy stance in an appropriate way. And so what is likely to happen is that given the resoluteness of the current team to fight inflation and their belief that hiking interest rates should do the work, reduce inflation, at the next meeting, the team is likely to maintain, the current monetary policy stance. I believe that they will want, to wait and allow the measures to play out or take effect so that they'll be able to assess in an objective way, the impact. So it's not likely that they will increase, definitely not reducing the monetary policy rate or the CRR. If I were in the team, that's what I would suggest, that let's watch the situation and how the effects play out, and then we get a robust assessment, perhaps at the meeting that will follow the March, meeting. Then they can take, good and fairly objective decisions.
You think it will be premature if they decide to change course by March?
Yeah, it will be very premature. They definitely can't reduce the monetary policy rate to the extent that the inflation rate is still very high. We don't even know what the February figure might be. Given the existing situation, it might still be a little higher because prices are still going up. And if that is the case, they would be well advised to watch the situation, monitor, and then check what is happening in the banks. Have interest rates increased as expected, lending rates? And if that is the case, what is the effect of that on investors, enterprises, and so on? So they'll be able to take a decision, let's say in the medium term, as to whether to increase further. But if the assessment shows that the measures are not working as expected, inflation is not trending downwards as expected, and they continue to hike the rates, that one will be a bit questionable.
Right, okay. Let's factor in the global economy, because the slowdown is also a global one. What do you make of how the global economy is trying to adjust to the Russia-Ukraine war, which is caused quite the disruption to the supply chain, you know, of you know, not just food commodities like wheat, for instance, but also caused some sort of energy crisis over the past few years because of, you know, the shortage of gas supply. Even though most economists say Nigeria should have capitalized on that, but the infrastructure is not necessarily there to meet global demands. But let's just suppose what is happening to the global economy and how Nigeria is also aligning itself with some of those changes and how things may likely change, especially as we consider all these new interventions by the CBN.
Well, the interventions, particularly those aimed at perhaps greater collaboration with the fiscal authority, because the fiscal authority is part of the problem of the central bank. And if the fiscal authority decides to appreciate the fact that their actions are causing problems for the monetary authority, so that they make the monetary authority less subservient to the fiscal authority, then definitely adjustments can take place. CBN actions can yield move in the right direction in terms of outcomes and so on. But otherwise, you know, CBN may continue to struggle in terms of achieving, you know, its mandate. The CBN has also announced that they will be collaborating more with the enforcement agencies, which is good, because there is a lot of manipulation and malfeasance, you know, in the financial system and the foreign exchange market. So invariably, most of the measures they are rolling out are in the right direction.
Right.
But in terms of the way Nigerian economy is adjusting, Nigerian economy is quite different from many other global economies. You talk about global inflation, the impact of the Russia-Ukraine war. It raised inflation level initially because of shortage of petroleum products, you know, agricultural products and so on. But inflation has been trending downwards in those economies, whereas inflation in Nigeria has continued to trend upwards. What that one means is that those economies have the capacity to adjust to the shocks occasioned by the Russia-Ukraine war. The way they are implementing their policies also hiked rates, but they are thinking of moderating the rates now because the inflation rate is moving in most of those economies towards their long-term targets or objectives. But because of the nature of the Nigerian economy, with so much distortions, so much imperfections and manipulations, we are not able to adjust. Most of those countries, those that have the capacity to produce, many of them have the capacity to produce agricultural products, they started producing and seeking alternatives. You know, energy, the US invariably started, you know, depleting its reserves and also escalating production of shale oil and so on. So invariably, those economies, because they have generally been better managed, are able to adjust to the shocks occasioned by a number of geopolitical tensions, including the Russia-Ukraine war.
Very interestingly, sometimes Nigeria has a way of defying textbook conventional measures that usually are supposed to address some of these situations. There's always something peculiar about addressing some of these challenges, whether it's economic, political or social in this country, but let's hope for the best as we experience the impact that this new direction is going to take us in. We're going to have to anchor the conversation here, Prof. Thank you most kindly for your expert analysis. We really do appreciate your insight, and thank you so much for joining us.
Thank you very much,
DAYBREAK
my good friend.
Thank you very much.
Much appreciated.
We have been speaking to Professor Mike Obadan, who is a professor of economy and, of course, is an educationist who has authored many books. He was the former Director General of the Nigeria Center for Economic Management and Administration, Ibadan, and a past member of the CBN board and former member of the Monetary Policy Committee.